In problem 2, we're going to examine the federal funds market and then analyze the effect of a shock, a change in reserve requirements, or the discount rate. The federal funds demand curve, or the demand for reserves, is given by this equation here, where S is a shock parameter that equals negative 39.1. RRR is the required reserves ratio, which is 10%. D is checkable deposits, $465 billion. And then A is the slope of the demand curve, which can be interpreted as banks' aversion to holding excess reserves. All the numbers have been copied into Excel. After we derive the numerical value of the demand for reserves equation here, we're going to derive the vertical section and the horizontal section of the reserve supply curve, which is a function of borrowed reserves, $0 billion, the quantity of non-borrowed reserves, $81.95 billion, and the discount rate, which is 3.3025%. All the numbers from Cengage now have been pasted into this Excel worksheet. The intercept of the federal funds, the intercept of the demand curve for reserves is the shock parameter plus the reserve requirement ratio times checkable deposits. The slope is 0.05. We're going to copy these into Cengage now. The vertical section of the supply curve is the sum of borrowed reserves, which is $0 billion, and the quantity of non-borrowed reserves, which is 81.95. So the vertical section is 81.95. The horizontal section of the supply curve is the discount rate, which happens to be 3.3025%. In the diagram here, we've graphed the demand curve, which is the downward sloping line. It has an intercept equal to 6.4. And it's downward sloping because it has a slope of negative 0.05. This dashed line here is the vertical section of the supply curve. And this dashed line here is the horizontal section of the supply curve. This height here is 3.3025, the discount rate. This right here is at the value of 81.95. I've copied this into Excel. This is the diagram that was copied in from Cengage now. The vertical section of the supply curve is that part of the cross. The horizontal section of the supply curve is this part of that dashed cross. And the equilibrium federal funds rate is about 2.3. The equilibrium federal funds rate is the interest rate that results when demand crosses the supply curve, which happens on the vertical section of the supply curve. When the demand curve crosses the vertical section of the supply curve, we refer to that as normal mode. In normal mode, the discount rate is higher than the equilibrium federal funds rate. So the discount rate is essentially a price ceiling on the federal funds interest rate. Now we want to compute the equilibrium quantity of reserves, equilibrium federal funds rate, and the Fed's target for the federal funds rate. Well, the equilibrium reserves, quantity of reserves, is just this value here, which was $81.95 billion. The Fed's target for the federal funds rate is 1 less the discount rate. If 3.3025 is the discount rate, then the target must be 2.3025. Now we're going to find the federal funds equilibrium. To get the equilibrium federal funds rate, we have to find where the demand curve and supply curve cross, and they cross right here. So this one's actually pretty easy. We plug in this value to the demand curve. So 6.4 minus 0.05 times the quantity of reserves, which is 81.95. So the equilibrium federal funds rate is 2.3025. Which of the following statements is correct? The equilibrium federal funds rate equals its target. That's true. The federal funds market is in normal mode. That is true. It's not in emergency mode, and it's not in crisis mode. So A and B. In part B, there's a European financial crisis. As a result, shock parameter S spikes, increasing by 0.8. This leads to banks hoarding reserves, which causes the excess reserve ratio to rise. The rise in the excess reserves ratio causes banks' aversion to holding reserves, A, to fall by 0.01. Drive the resulting demand for reserves. So S increases by 0.8. So we're going to add 0.8 to S. The aversion to holding reserves falls by 0.01. So we're going to subtract off 0.01. And so the new intercept of the demand curve is 7.2. And the new slope is 0.04. And so this red equation's graph is this red line. I've copied and pasted this, as you saw, into Excel. So this is the new demand curve for reserves. Demand crosses the initial supply curve on the horizontal section. We call this emergency mode. In emergency mode, the equilibrium federal funds rate has risen to equal the discount rate, which is, again, a price ceiling on the federal funds interest rate. The federal funds interest rate is in equilibrium 3.3025. The quantity of reserves has to increase. Otherwise, if it remains at 81.95 billion, the federal funds rate would actually rise up to this level. So the Fed's got to make discount loans in the amount of this difference graphically. So the difference between this value here and that value there is the amount of discount loans the Fed has got to make to keep the federal funds rate from rising above 3.025. To find this quantity of reserves here, we have to set the new demand curve equal to the discount rate. We've done that over here. We want to solve this for R. This is your discount rate, and this is the right-hand side of the new demand curve. So down here, we've added 0.04R to both sides of the equation and subtracted 3.3025 from both sides of the equation. And then down here, we've divided both sides of the equation by 0.04. So the quantity of reserves is equal to 7.2 minus 3.3025 divided by 0.04, which is 97.4375. The target for the federal funds rate is still 2.3025 because the discount rate is 3.3025. Which of the following statements is correct? The new equilibrium federal funds rate equals its target. No. The federal funds rate market is now in normal mode. That is not correct. The federal funds market is now in emergency mode. That is correct. The federal funds market is in crisis mode. That is not correct. So it has to be C. How many billions of dollars does the Fed have to make in discount loans? Well, to get that, we have to subtract this new value for quantity reserves from the previous value of quantity reserves, which is 81.95. So discount loans have to be equal to 15.4875. If the Fed doesn't make $15.4875 billion in discount loans to banks, the federal funds rate will rise to what value? If the Fed doesn't make that much in discount loans, the quantity of reserves remains at 81.95, and it looks like the federal funds rate would rise to just under 4. To calculate that value, we just plug in the original level of non-borrowed reserves, 81.95, into the new demand curve. So the new intercept minus the new slope times the original quantity of reserves, and we get 3.922. Instead of the financial crisis we talked about above, suppose the Fed had changed the required reserve ratio instead, and this causes shock S to spike, the excess reserve ratio to rise, and bank conversion to holding reserves fall, which resulted in the same reserves demand curve below, 7.2 minus 0.04 times R. The rippling effects of changing the required reserve ratio is shown in the graph below. Since it's the same diagram above, changing the reserve requirement ratio puts the federal funds market in emergency mode, requires the Fed to fill this gap here, 97.4375 minus 81.95, with discount loans totaling 15.4875, and the federal funds rate rises up to the discount rate, which is 3.3025. Which of the following statements is correct? The new equilibrium federal funds rate equals the discount rate. That is true. The Fed has to make discount loans to prevent the federal funds rate from rising above the discount rate. That is true. The federal funds market is now in emergency mode. That is true. Changing the required reserve ratio and financial crisis have similar effects. All of the above. Instead of the scenarios in Part B and C occurring, suppose the Fed raises the discount rate by 50 basis points. The new reserve supply curve is given by what? Well, the vertical section does not change, $81.95 billion. The discount rate was 3.3025, but that's been raised 50 basis points. So we add 0.5 to that, we get 3.8025%. So when the Fed raised the discount rate, the supply curve rises vertically. The target, the federal funds rate, is no longer 2.3025, is 2.8025. So the new target is higher. Which of the following statements is correct? The federal funds market remains in normal mode. That is true. So B and C are not true. Raising the discount rate by itself does not change the quantity of reserves. Raising the discount rate does not affect the federal funds rate directly. So A has to be the correct answer. I'm going to leave Part E to you guys. I'm going to check my work and I should get everything but Part E correct. I didn't get them all correct because I did not use 3 decimal place accuracy, so I'm going to go back, change all of my answers to 3 decimal places. So 3.03, 2.03, 2.03, 438, 3.03, 2.303, 488, 3.803. So I'm going to recheck my work, and it looks like I have everything correct now, but Part E.